Picture this. Your portfolio just cratered, and you did what felt like the responsible thing. You sold to stop the bleeding and told yourself you'd get back in once things calmed down. Then, with zero good news, the market rips 15% higher in under 2 weeks. And that sick gut punch feeling watching everything you sold shoot higher? That's not FOMO. That's the exact emotion that leads people into an even bigger mistake. Zoom out, and here's the actual data behind that feeling. A major stock index fell more than 30% from its high, and then did something almost no crash ever does. It never bounced. Not once. No relief rally, no dead cat bounce, just straight down. And then, out of nowhere, it exploded back up. No news, no headline, nothing you could point to. If you think that sounds like good news, I need you to stop and listen, because this exact pattern is how people who survive the crash lose everything in the rebound. Here's my conclusion before I explain anything. The bounce after a crash is almost never the crash ending. It's usually mechanical, forced, and temporary. And treating it like the bottom is exactly how leveraged accounts get wiped out twice in 1 year. My name's Moon, and I spend an unhealthy amount of time tracking where institutional money actually moves. Not what the headlines say, what the flows say. If you've ever bought a dip that kept dipping or sold at the bottom out of pure panic, this video is for you. Hit subscribe, and if this actually helps you, tap like. It tells me to keep making the videos that cut through the noise instead of chasing it. Okay, so here's the financial common sense I need to break first. Most people think a rebound after a crash means the danger is past. Actually, it's usually the opposite. The sharpest, fastest rebounds tend to come from forced buying, not from anyone deciding the market is actually safe again. In the case we're breaking down today, the index had fallen more than 30% from its peak with zero real bounce for the entire slide. That's your first clue. Something structural was going on. Real, fear-driven selling usually gets interrupted by bargain hunters way before 30%. So let's actually follow the money, because there are 3 totally different sellers stacked on top of each other, and most people lump them into one group: panic. The first is straightforward panic selling. Retail investors dumping shares regardless of price purely out of fear. The second is forced selling through margin calls. When an investor's collateral falls short, the broker liquidates the position mechanically on a clock with no regard for price. In this market, that clock is brutally short, roughly 2 days from the margin call to forced liquidation, and once that window closes, the selling isn't optional anymore. Let's put a real number on that, because it hits different than a percentage. Say you put in $20,000 of your own money and borrowed another $20,000 on margin. Now you're controlling $40,000 of stock. The market drops 30%. Your $40,000 position is now worth $28,000, but your loan is still $20,000, untouched, because the broker doesn't share in your losses, which means your actual equity, your real money, just went from $20,000 to $8,000. That's a 60% loss on your own cash from a 30% move in the market. That's why the broker's 2-day clock exists, to protect the broker's money, not yours. Here's the analogy that makes the mechanism click. Imagine a landlord who legally must evict a tenant the moment rent is 2 days late. It doesn't matter if the tenant loves the apartment or thinks the rent will bounce back tomorrow. The eviction happens on the clock, not on hope. The third seller is leverage itself. Products built to amplify moves, which mechanically accelerate selling as volatility spikes, adding fuel exactly when the fire is already burning. Stack all 3 together and you get a waterfall, not because everyone decided the company or the economy was suddenly worthless, but because selling triggered more selling, mechanically, on autopilot. So now flip it. When that same market suddenly rips higher with no news, ask one question: who's buying and why now? The first driver is simple exhaustion. The forced sellers finally run out of shares to dump, and the relentless downward pressure just stops. The second is short covering. Traders who bet against the market have to buy shares back to lock in their profits, and that buying itself pushes the price up further. Here's the analogy. It's like a room full of people who all bet a chair would break. Once it doesn't, every single one of them has to rush to grab a real chair before the music stops, and that stampede alone can look like genuine demand, even though it's just people covering their bet. The third driver is genuine bargain hunting. Once a stock is effectively cut in half, value-focused buyers start stepping back in. The fourth is policy intervention, leverage restrictions, rate cuts, or large institutional buyers stepping in to stabilize the market. Notice something. 3 of those 4 buyers, exhaustion, short covering, and policy support, have absolutely nothing to do with the actual health of the economy or the company. And this is where it gets political. So let me be balanced about it. Governments and pension-style institutions almost always step in during a crash like this, because a market collapse becomes a policy problem, not just an investor problem. But that intervention buys time. It doesn't automatically buy a fixed problem, and the two get confused constantly. So here's genuinely where it gets interesting. How do you actually tell a real recovery from a dead cat bounce before you bet real money on it? Signal 1 is leveraged debt actually shrinking, meaning the margin balance that fueled the crash are genuinely being paid down, not just quiet for a day. Signal 2. Have retail investors actually stopped buying the dip out of exhaustion rather than just pausing for a day before jumping back in? Signal 3 is foreign or institutional money coming back consistently, not a single big day, but sustained buying over roughly 2 weeks or more in real size. Signal 4, has there been a genuine fundamental turn upstream in the big global companies and sectors that actually drive the broader market, not just a relief rally in the names that fell hardest? Here's the analogy that ties all 4 together. A real recovery is a patient whose vitals actually improve, heart rate, blood pressure, blood work, all of it, not a patient who just stopped screaming for a minute. If you only check 1 or 2 of those 4, you're not looking at a recovery. You're looking at a really convincing dead cat bounce wearing a recovery's clothes. Now here's what to actually do with each type of position, because wait and see isn't a real plan. If you already trimmed your position before the crash, don't rush back in. Wait until at least 2 or 3 of those 4 signals are confirmed, not just hoped for. If you're fully invested or worse, underwater on margin, use this bounce, this exact bounce, to bring your exposure back under 100% of your actual capital, not to double down hoping to break even. And if you're holding leveraged products, this bounce is your exit, not your victory lap. Take the relief and get out, because leverage doesn't forgive a second crash the way your account did the first time. Now, I know exactly what a lot of you are thinking right now. Moon, yeah, it already bounced 20–30%. Isn't this just you being needlessly paranoid at this point? Well, fair question. And here's my honest answer. A big bounce off a big crash is exactly what you'd expect from forced buying too, so the size of the move alone tells you almost nothing. The only way to actually know the difference is the checklist we just went through. Debt shrinking, retail exhausted, institution sustained, fundamentals turning, not how big or fast the green candle looks on your screen. So no, I'm not saying sell everything and hide. I'm saying don't confuse relief with resolution, because that confusion is exactly what turns one bad crash into 2. Here's what people genuinely don't get about crashes. It's not the falling that wipes people out. Most people survive the falling. It's the bounce that gets them, because relief makes people careless in exactly the moment they need to be most disciplined. I've watched this exact pattern play out over and over. Someone survives the crash, relaxes the moment it bounces, and gives back everything, plus more, towers on the very next leg down. So this week, do one concrete thing. Pull up your own portfolio and just check. Are you at, above, or below 100% invested right now? No leverage hiding in the number. If this helped you separate a real recovery from a convincing fake one, that's exactly why I make these. Hit subscribe, drop a like, and let's keep studying this stuff together so you're never the one holding the bag on the second crash. Protect and grow what you've built.